There is a golden rule in modern finance. You cannot capture a high long-term return without taking on high risk and volatility. This risk-reward trade-off drives the most common advice in personal finance. Planners will tell you that mathematically, you are better off renting a home and putting your capital into the stock market. The logic seems airtight. A house is a physical structure, requiring constant maintenance, annual property taxes, and transaction fees. A corporation, on the other hand, exists for one singular purpose: to maximize and compound earnings. Economists map this trade-off on what is known as the efficient frontier. Down here at the bottom left, you have safe assets like government bonds, low risk but very low return. At the top right, equities are highly volatile but compensate with high long-term returns. Because a house is a physical asset with high friction costs, the standard model dictates it sits in the middle, offering lower returns than stocks with slightly less volatility. If this widely accepted asset pricing model holds true, maximizing a family's net worth demands prioritizing equity markets over residential real estate. A comprehensive macroeconomic dataset from the National Bureau of Economic Research, titled The Rate of Return on Everything, tracks asset performance across 16 advanced economies. The researchers compiled data spanning from 1870 to 2015, tracking returns from the post-Civil War era to the modern day, filters out short-term market anomalies, and reveals the true underlying behavior of capital. The data reveals that over a century and a half, the long-run real total returns of residential real estate and equities are essentially identical, but housing achieved those exact same returns with only half the historical volatility of the stock market. This empirical reality breaks the foundational model of risk and reward. It proves that residential real estate is a massive anomaly in asset pricing theory. This chart shows average real returns across 16 global economies. On the left, housing and equities share an almost identical average return of 7%. Bonds and bills sit far lower, confirming the massive premium for holding housing or stocks. To understand the anomaly, we have to look at standard deviation. This metric measures investment risk and historical volatility. A higher standard deviation means wilder price swings. Equities have a 22% standard deviation, plotting high and far right on a risk-return scatterplot. Housing standard deviation is only 10%, reaching the exact same height but sitting far left. Housing completely violates the expected diagonal risk-reward trajectory. In finance, the Sharpe ratio measures exactly how much return an investor generates per unit of risk they absorb. Across all 16 countries in the dataset, housing consistently provides more than double the risk-adjusted return, or Sharpe ratio, of equities. The raw historical data proves an incredible reality. An asset does not require equity-level risk to generate equity-level wealth. If the historical data is this irrefutable, why do financial planners and prominent economists consistently claim housing is a poor investment? Analysts frequently fall victim to the yield illusion, mistakenly comparing the total return of the stock market against only the price appreciation of real estate. Nobel laureate Robert Shiller compiled one of the most widely cited historical datasets tracking U.S. home prices. Looking at Shiller's historical house price index, real house prices grow just 1% above inflation. This stagnant middle section convinces analysts that real estate is a terrible financial vehicle compared to compounding stocks. But evaluating housing solely on its resale price is like evaluating a stock while completely ignoring a century of its dividend payouts. It misrepresents the asset's true wealth-generating power. The massive missing component that conventional financial wisdom ignores is net rental yield. This yield applies universally. Landlords realize it as actual cash rent collected. Owner-occupiers realize it as imputed rent, the housing costs they save by not having to pay a landlord. Equities generate their 7% return through 40% capital gains and 60% dividends. Housing's capital gains are a tiny 1% sliver. The remaining 6% is massive rental yield. Unlike wildly fluctuating stocks, housing's rental yield remains stubbornly stable. Financial professionals often counter this by pointing out that housing requires property taxes, massive maintenance costs, and high transaction fees. The NBER researchers already accounted for those variables. The 7% housing return figure is strictly net of these costs, providing a precise apples-to-apples comparison with equities. Furthermore, these figures assume zero leverage. The standard practice of purchasing real estate with a 30-year mortgage would mathematically magnify those housing returns even further. The relentless low volatility compounding of rental yields drives the true growth of real estate wealth. This steady 7% return extends beyond individual portfolio theory. It dictates capital accumulation across the broader macroeconomic landscape. The economist Thomas Piketty popularized a central macroeconomic framework defined by a simple equation: R is greater than G. The theory states that when the rate of return on wealth, R, persistently outpaces the rate of overall economic growth, G, wealth inevitably concentrates over time, driving systemic inequality. When the public hears about the return on capital, they generally assume the equation refers to billionaire stock portfolios or massive corporate assets. But the absolute largest component of global capital is actually residential real estate, taking up nearly half of all investable wealth. Because housing holds such a massive weight in the global economy, its steady 7% return is the primary mathematical driver, keeping the aggregate return on capital higher than economic growth. The quiet, stable returns of everyday residential housing drive global capital accumulation. People buy homes for non-financial reasons: emotional stability, community, and social integration. Financial planners often write these factors off as mere behavioral biases. Despite these non-financial benefits, the historical data proves housing is a highly efficient, top-tier financial asset class. This challenges our deepest assumptions about market efficiency. It proves that markets do not always perfectly price risk and reward on a neat, proportional diagonal line. The truth is, investors do not necessarily have to absorb massive, sleep-depriving volatility to build generational wealth over time. While renting and buying stocks may be the conventional formula for optimized wealth, 145 years of empirical history proves that owning the roof over your head is just as mathematically powerful, with a fraction of the historical heartache.